Hey guys, in this video, I'm going to be showing you how I fully analyze a stock. I'm going to be going over every metric I look at, all the most important ones. This is how I really analyze a company to see if this is a really quality company or not a good one. And most of the time, or pretty much always, the fundamentals of the company have to go up for the stock price to go up. Like usually the growing net income aligns with the growing stock. And I like to consider myself a stock picker. I love individually picking up stocks. Here's my entire portfolio, by the way. Here's every stock that I own. This is my buy and hold portfolio. And then over here, I have my risk on portfolio. We have some really big winners in here. If you're going to be an individual stock picker, you got to make sure you're picking some high quality companies to outperform the market. Of course, you're going to have some losers as well, like I do. UiPath, Zoom, Enphase, AMD. And then we also, of course, have my Robinhood account. This is my main taxable account. These are dividend growth stocks. Every stock in here pays a dividend, but most of these, as you can probably see, are dividend growth companies like Meta, Google. And here's my total percent change on every stock. Luckily, we are up on every single stock here. If we go to year to date, we're doing a little better than the market. We're up 2.47% year to date. And then we also have our small Roth IRA. I think it just hit an all-time high. Yeah, so our Roth IRA just hit a new all-time high thanks to InnoData right here. This is like our hidden growth stock. But yeah, I love individually stock picking. And let me show you a little bit more on how I do this. All right, so really, I love looking at fundamentals and financials of companies. And this is what we're going to be looking at in this video. At the beginning, I'm going to be sharing you what metrics you should be looking at, the most popular ones. I'm going to be explaining like these three down here are so important to know what all three of these are, the cash from operations. And then toward the end of the video, I'm going to be showing you how to get some premium tools for free. Everything in this video I'm using is for free. You don't have to pay for anything. I'm going to be showing you some free websites. And this app right here, Webull, is completely free. You don't have to deposit any money. You can just download the app for free, and all the tools I'm using, you can get completely for free. You don't have to open a brokerage with them. And let's get straight into the video. If you like this, please drop a like on the video for me. And let's just get straight into the video. I'm going to be explaining what everything is. And this information will be important whether you're a new investor or someone that's been in the market for a couple years. And we'll go to some of the more basic metrics here in a second. I want to start out with the cash flow statement. This is one of my favorite things to look at for a company. And there's three things we can look at here: the cash from operating activities, investing activities, and the financing activity. So we'll just start with financing right here. So if a company issues debt, this will be positive. If they dilute you as a shareholder, this will be positive. And normally it's negative. You want this to be negative. That means they're returning money to the shareholder. So this negative money right here could be dividend payments, stock buybacks, or paying off debt. But for this stock right here, most of this negative every quarter is them paying their dividend. They do a little bit of stock buybacks. But as you can see in the most recent quarter here, they just issued 260 million of debt and rose some cash for that. And I'm okay with that, because if we go to the investing activity, they actually just invested $467 million into new assets. So if this is negative, that's a good sign. Now, if we see it's positive, that means they're selling an asset. They sold off maybe a property, they sold off part of their business. That means they're selling assets. But you normally want to see this be negative, because that means they're reinvesting into the company, buying new assets. And then we, of course, have the cash from operating activities. And this isn't the free cash flow, but this is an important metric you want to look at. This does include negative debt interest payments. So let's say you have a lot of debt and you're paying a lot of negative interest on it. Well, this is the number after paying all the negative interest. And this is, you should look very different from the net income, because the net income includes stock-based comp. Now, if there's a non-cash expense like stock-based comp, that's not included in the cash from operations statement. So here we are on a different stock right here. This is Roblox. Look at their operating activities. They made 443 million in the most recent quarter. This doesn't include stock-based comp. That's why a lot of people also, you need to look at the net income, because this is the GAAP net income. It does include stock-based comp. And this is what's so crazy. Roblox made a record 443 million, nearly 400 million of free cash flow, but the net income was still negative 200 million. That's because there's stock-based comp. Roblox has so much stock-based compensation. That's where they're paying employees with stock instead of paying them with cash. And if they had to pay them with cash, it would be super, super expensive. So let's go look at another company right here. So now I want to explain what some of the more basic metrics are. So here we are on Amazon. We all know Amazon. Let's go check them out right here. So the EPS is just the net income per share. And check this out. If we look at the net income, look at the green number at the bottom below it. It's up 62% year over year. If we scroll back up and look at the EPS, which is the net income per share, it's also up 62%. Now, sometimes it'll be up more, like you'll see the EPS is up more than how much the net income is up. That means they're buying back their own stock, but we can see with Amazon, they're not buying back or issuing any shares. They're not diluting you. And we can see the net margin as well. This is what's so impressive with Amazon, this net margin expansion. So check this out. If we look at the sales, the total revenue, the lifeblood of the company, it's up 8.62% year over year. So the revenue is up 8.62%, but look at the net income. The net income is up 62%. That is so impressive. That means they're growing their net margins. And look at this. A year ago, their margins, were single digits, 6, 7%. But look at how they just grow it every quarter. Now Amazon has an 11% net margin. And that's super impressive, for them to expand their margin like that. And we can also check the operating income. This is also an important thing. You want to compare the net income to the operating income. Operating income doesn't include the taxes, but sometimes there will be artificial adjustments to the net income. And I'll show you that, for example. Like if we go over here and look at DocuSign, for example, this is a company that just reported earnings. I do own this one. If we look at their net income right here, you see how it was that one quarter, $888 million. This can sometimes happen. This is just a one-time adjustment. We really want to look at their operating income. As we can see, yeah, that huge $800 million spike is not in the operating income. That was because of a tax adjustment. They had acquired a company called Lexion, and it gave them some tax write-off or whatever, and they were able to make $888 million in net income. That wasn't real from the company. I mean, it really helped out their balance sheet, but if we go to the operating income, we can see that they didn't actually make that from the core business. That was some accounting trick. So I like to compare the operating income to the net income to see if there's any accounting tricks. All right, so here's some other very important metrics you want to look at when analyzing a company. So you want to look at the PE ratio to the left here. As we can see, the PE ratio TTM, which is trailing 12 months, is a 30. And the forward PE is a 26. That means they're expected to grow their EPS and grow their net income because the EPS is just the net income per share. It also includes any stock buybacks, or if they diluted you, then the EPS would go slightly down versus the net income. But let's go analyze a random company, for example. These are some of the most important metrics you want to look at. Here's how you see if a dividend stock has a safe dividend. So right here, the net income in the most recent quarter was $169 million. Sometimes you can look at a free cash flow as a dividend payout ratio as well, but let's just look at the net income. They made $169 million of net income just in the most recent quarter. In this stock right here, the dividend only costs $14 million. They have so much room to raise their dividend. The dividend is very safe. And then another thing I like to look at is the issuance retirement of stock. That we can see if this company is diluting you or buying back stock. And as we can see in the most recent quarter, they just spent $100 million on stock buybacks. Actually, you can find all this in the cash flow statement. So if we go to the cash flow statement down here, kind of got to scroll through things, but we can see right here, total cash paid dividend, $14 million. Issuance retirement of stock. They bought back $91 million of stock. And then we can also see issuance retirement of debt. Now, if a company is issuing debt, this would be positive, but this company right here hasn't issued any debt in a long time. They're actively paying off all their debt. And if we go to the balance sheet right here, we can see how much debt and cash they have. So check this out right here. We see their cash and equivalents is $204 million. This means if this company has any treasury bonds, like usually these companies keep like 1 to 3 week treasury bonds. This is still included in that. So they have $204 million of cash. We scroll down here. We're going to look for their total long-term debt. Look at the total debt here. Debt is $63 million. They literally have 4x more cash than they have debt. So that's what's really cool about this company right here. We can also go to the income statement. This just shows you, like, you can see the gross profit. It's on the left here now. It's up 35% year over year. Just some of the more things right here. Oh, and their interest payment. And this is where you can find the diluted weighted average shares outstanding. Like, check this out. You now own 0.62% more of the company. This is what I like to look at. There's right now 35.6 million shares. If you scroll out to like 2019, there were 37 million shares. So this company is actively buying back their own stock. And when they buy back their own stock, that's giving you more ownership in the company. So you now own more than you did a year ago. And we can also see the diluted EPS right here. The DPS is the dividends per share. Look at this company right here. They literally raise their dividend every quarter pretty much. It's 40 cents in the most recent quarter. Used to be 10 cents. So they're really increasing their dividend and still have that very low payout ratio and the diluted normalized DPS. Check this out right here. here. So they're raising their dividend like crazy, but also just growing the business. Their normalized EPS is literally up 77% year over year. So FIX, this is a really cool dividend growth stock that I own. It's actually my largest holding. I have like $6,000 in this stock, but I'm just using them as an example. I like to look at the metrics of all these for all the stocks that I own, and all the companies that I own, the fundamentals look very similar. Like another one I love, Coca-Cola Consolidated. This one's kind of on a dip right now. I've been buying the dip on this company. Let's go analyze them like I did the last stock. I'll be quick about this. So as we can see, they're making, 100 to 200 million a quarter. So we'll just say 120 million of net income a quarter. We go to the cash flow statement to see how much their dividend cost. Check that out. Their dividend only cost $21 million. You see how it was like 154 million right here? That's when they do a special dividend. They did a special dividend that quarter. But anyway, they have a very low, like 15, 20% dividend payout ratio, very low dividend payout ratio. And we can also see their stock buybacks right here. Check this out. They didn't buy back any stock in the most recent quarter, but look at this right here. They never issue shares. They haven't issued any shares since 2016, but randomly, look at this, in 2024, they bought back $560 million of the stock in that one quarter. And remember, $560 million, this whole company is worth $9.5 billion. They bought back literally 8% of the company at the time. The market cap was much lower at the time, but they literally bought back 8% of all the shares that exist in that one quarter. So that's what's very cool. Very shareholder-friendly company here. Let's go look at the balance sheet. Let's see what's their cash versus debt. So right here, we can see their cash and equivalents. Coca-Cola has $1.5 billion of cash on hand. So $1.5 billion of cash, and let's go find their total debt. So total long-term debt, $1.4 billion. So they can pretty much pay off all their debt right now if they wanted to. So all the net income that they're making right now, this can be used toward, stock buybacks. We go to the financing. This was when they issued debt. They issued 1.15 billion of debt. Then if we look right here, this negative 500 million, that's when they did those crazy stock buybacks. They returned 500 million to the shareholder in the form of buybacks. But yeah, they had that one time. Normally they're always returning money to the shareholder. Very shareholder friendly company. And they're not, look at this, we go to their investing, they're always reinvesting back into the company, into new assets. Like they just had this new $90 million facility they're building out, and they can afford that too. Look at this cash from operations. They made 198 million, and they're investing 140 million. The operating activity easily affords that. So those are all the metrics I like to look at. When we look at those same metrics on something like a Tesla, this stock is one of a kind. And I'm not here to hate on Tesla, but this is why a lot of people don't like them. This is a very bad company. Check out the revenue right here, or financially speaking, right now. Obviously, the growth is going to be in a couple years when there's the robo-taxi network, all that. But look, for right now, the revenue fell 9.2% year over year, and the net income fell 70% year over year. So if we go and look at Tesla's net margin right here, it was down 68% year over year. Tesla's net margin was just a 2%. I mean, that's, for a company that used to have double-digit margins, I mean, the company, this is what's really weird. The stock price is not following the fundamentals here. And so that's why a lot of people just stay away from Tesla. This is why I stay away from Tesla. And honestly, if you're wondering, if you ever look at a stock like this, if you're kind of new to the market and you see a stock like Lucid, if you're wondering, hey, why is Lucid at all-time lows? Like, how can a stock do this? How can a stock just keep on going lower? Well, this is how. Look in the top right, the market cap, the whole company is worth $6.5 billion. And look at the net income right here. This company just loses so much money every quarter, and they're diluting you. Check this out. So in the past year, I mean, that one quarter, they lost $1 billion. The losses are getting a little bit better, but and the revenue growth is there, which is good. But this is why the stock's at all-time low. They're still losing 400 million a quarter. And if you annualize the trailing 12 months, how much they've lost over $2 billion. They've lost over $2 billion the past year of net income, and the whole company is worth 6.5 billion. And check this out. They also can't dilute you. The stock's at an all-time low. How are they going to issue shares when the stock's at all-time low? But they're still doing that. If we go to the total common shares outstanding, I don't believe this. I literally can't believe this. You've been diluted 32%. You now own 32% less of the company. Look at last quarter. They issued this while the stock was at all-time low. This is the only way the company can stay afloat. They can't raise debt. They have to issue shares, and that's why they don't care about the shareholder. They diluted you by 1.75 billion, and the whole company is worth $6 billion. I mean, this is a classic company you want to stay away from. That's how they have all these negative net income quarters, and their debt is staying at 2 billion. They can't raise debt, and I can't believe this. The total common shares outstanding are up 32%. Like when this company IPO'd, there were 258 million shares. Now there's 3 billion, up from 2.3 billion. Anyway, I think you kind of get the point here. You want to stay away from these companies. They'll just slowly bleed lower. And I've lost money on a stock like this. This is what I bought. I used to never look at financials. A long time ago, I never looked at financials. And this is one of my biggest losses. I just like being completely transparent. This is ChargePoint. And I sold all my shares. Where did I sell my shares at? So check this out. I completely sold out of all my ChargePoint at $2.85. Look at that. You see the sell? I pretty much sold it at an all-time low. And check this out. I say thank goodness I sold all my shares at $2.85 because now this stock just keeps on going lower. Check this out. If we look at their net income right here, they're just burning net income. They're losing all this net income and they lost their growth. Look at that. The sales are down 8% and they're losing a boatload of money. This company is trending toward bankruptcy. And I'll show you where I bought my shares. So as you saw, I just sold all my shares at $2. Dude, I was buying this stock. Yeah, I was buying all my stock up here at $20, $13, $14. Look at that. I was dollar cost averaging in at $15 and I sold it all at 2. So that's my lesson here. Always look at the fundamentals because the only reason ChargePoint's at 0 is because they're burning so much net income. The fundamentals aren't growing. I like looking at the fundamentals of a company. That's why I'll stay away from Tesla, but I'll maybe buy a Palantir because the fundamentals are so great there and growing. So anyway, if you found any value in this video, please drop a like on the video for me and consider becoming a member to the YouTube channel. Hit the join button if you want. I'm just completely transparent. I'll show you all my stocks I own, how much I'm up and down. Completely transparent. Anyway, check out the video up here as well, and I hope you have a great rest of your day, and drop a like on the video if you have not done that. Thanks again. See you later.